Hello friends, how are you? I hope you all are doing really good. So guys, we were done with chapter number 1, that was introduction to financial management, and I hope the basics of financial management, whatever we discussed, are clear to you. Now we are moving on to our second chapter, very important chapter of financial management, chapter number 2, that is working capital management. This is working capital management. Very important chapter from examination point of view. Highest weighted chapter, one of the highest weighted chapter, right? Because we have multiple components in this chapter. So this is a very important chapter. Just listen to each and every concept very carefully. We'll go with the basics, right? We'll go with the very basics, that what is working capital management, how we go about doing the things, right? We'll go with the very basics. Just listen to each and everything very carefully, and wherever you feel that you are getting some difficulty, do contact me through WhatsApp, through Telegram, through mobile app, email, whatever the source is comfortable to you, right? Now, coming to this chapter, working capital management, this chapter is divided into multiple components, right? What are the various parts of this chapter? We will see, and we'll discuss how we are going to proceed with that, right? That how we are going to cover all the topics. So the first part of it is estimation of, the first is estimation of working capital. Estimation of working capital, right? Then the second part is cash management. Second part is cash management. Third is debtors management. Then fourth we have, that is inventory management. And the last one we have is creditors management. Right? So these are the 5 components of this chapter. The overall chapter we call it as working capital management, but these are the 5 components: estimation of working capital, cash management, debtors management, inventory management, and creditors management. Now, if we talk from the examination point of view, this creditors management is not important at all, right? This thing I've just explained a little bit in the ICAI SM series of financial management. I'm not going to touch upon the creditors management, or at the end we will see, right? Inventory management is what we have covered in material costing of cost accounting, material costing EOQ. Material costing EOQ is inventory management, nothing new in that, right? So I am not going to cover it here. We have already covered in cost accounting. All those who haven't studied cost accounting, they can watch my YouTube lectures, right? There they can watch the EOQ lectures. That is inventory management, nothing new in that. And from the examination point of view, not very important, but yes, a few times it has been asked, right? Simple question, asked simple question, right? In May 22 attempt, this inventory management question was asked, which was least expected, but yes, if you have gone through with the cost accounting part, then it is one of the simplest part, right? Coming to these 3 parts, these three are very important from examination point of view: estimation of working capital, cash management, debtors management. All these 3 are very important, most important from examination point of view, right? So we are going to cover first these 3 parts: estimation of working capital, then we will cover cash management, then we will cover debtors management, and I will go with the very basics, right? Very basic examples we will take. So let's start with the first part, working capital. So first we'll try to understand. First we'll understand, sir, what is working capital? What is working capital? Right? We'll try to understand what does it mean by working capital. Now, we have often studied this word capital, isn't it? From the very smaller classes, from plus one, plus two accounts, when we studied about accounts, we have studied this terminology capital. What is capital? Capital is any money required. This is money required to run a business, right? Capital is what? A money required to run a business. Now, this money can be of two kinds. This requirement of money can be of two kinds. One can be long run, long term. The second is short term. That is, we need money for the long term. The money is invested in the business for many years altogether, right? The second is short term, that you borrow money for a shorter period of time. There is some emergency in the business. You borrow the money for a short period, return it, right? What is short period? Short period is a period of less than equal to 1 year, right? If it is more than 1 year, we call it as long term. Clear? So capital is any money which is required to run the business. Thus, this requirement can be long term and short term. What are the examples of the long term one? The long term can be equity share capital that we have studied, because we invest this capital, we invest this money for a longer period of time. It is not that we invest today and withdraw our share capital within 1 year. No, we invest it for a longer period of time, right? Can be preference share capital. So all these things are the long term ones. When we talk about the short term, in the short term, we talk about working capital, right? We talk about working capital. Now, what is this? This means the money required for a period of less than 1 year, for a period of less than equal to 1 year, and this money is used for meeting day-to-day expenses, right? For meeting day-to-day expenses. This is working capital. That is, when we require money for a shorter period of time, that is less than 1 year, and this money is used for meeting day-to-day expenses. Let's take a very simple example to understand it. Let's take a very simple example. All of you must be taking some pocket money from your parents, isn't it? No, sir, we are getting a stipend. How much stipend are you getting? We all know, right? Although the new scheme is coming, but under the new scheme also, how much you will actually get, you will get to know later on, isn't it? So let's say you are getting a pocket money of 10,000 per month, right? Now, you will keep this 10,000 rupees for many years, or you will do the expenditure. Your parent says whatever the expenditure you have to make, right? Your fuel expenses, your party expenses with your friends and everything, you have to manage it from this 10,000. The fees, this coaching fees is extra, right? That forget about it. But your routine expenses, for your routine expenses, you have to make out of your 10,000. Now, this 10,000 you will keep in your pocket. Your pocket is your business. Now, this 10,000 you will keep in your pocket for many years, or you will spend it? Sir, obviously, within a month we will spend it, right? Now, this 10,000 is what you are getting. This thing you are getting to meet your daily expenses, to meet your day-to-day expenses, right? When you are getting a money to meet your day-to-day expenses, this pocket money becomes your working capital, right? That is the money for a short period of time to meet your day-to-day expenses. That is known as working capital. Clear? Now, sir, is the management of working capital important? Obviously, when you are getting this 10,000 rupees, right? Now your father says you have to manage everything for a month out of this 10,000. So if you don't know how to manage your working capital, there are high chances that by the end of the month you have done the reckless expenditure, and when there is a time to buy something really worthwhile, you don't have the money, right? So you really have to plan the things, you have to manage this money in such a way that you are left with some money, or you are doing the optimal utilization of this money. Clear? In meeting your day-to-day expenses for the purpose for which this money was received. Any doubts? So the basic is clear. Working capital is what? Working capital is the money that is required by a business in the short period of time to meet their day-to-day expenses. When we talk about the longer period of time, we have many other sources. Equity share capital is there, debt is there, preference share capital is there. All that money is invested in the business for a longer period of time when we are planning for something long, right? For longer investments, for buying some assets or something like that. In that case, we go for the long-term capital sources, but for meeting our day-to-day expenses, we go for the short-term sources of finance, that is known as working capital. If you remember the initial chapter, the introduction to financial management, the last chapter, in the last lecture itself, I told you that flow chart we made, that when we are talking about the short-term investment, short-term sources of finance, we look for working capital, right? Now in the financial terms, now if we talk about in the financial terms, what is working capital? In the financial terms, we say working capital is excess of current assets over current liabilities, right? So what is working capital? Working capital is excess of current assets over current liabilities. We can write it as working capital is equal to current assets minus current liabilities, right? So in the financial terms, this is working capital requirement. Current assets minus current liabilities. What do we mean by it? Listen to it very carefully. I'll take a few examples for it. Example 1. I'll say cash. Cash is what? Cash is your current asset, isn't it? Say you have a cash of 10,000 rupees in your pocket, right? There is a current liability, there is some creditor. Creditor is what? Current liability. There is a current liability or the creditor to whom you have to pay 10,000 rupees. You have 10,000 in the pocket in the cash. You have a creditor to whom 10,000 is to be paid. Now you paid 10,000, right? What is the cash balance left with you? Cash balance is nil. This is your cash balance now. Now you don't have any money in the pocket. If you don't have any money in the pocket, how will you meet your day-to-day expenses? Right? Now the question here is, how will you meet your day-to-day expenses? Isn't it? You will obviously find difficulty. So what is the interpretation of it? We say that we must have cash in excess of our current liabilities. If you have to pay 10,000 rupees to an outsider, to another person, you must have a cash of 15,000 in the pocket. Why? So that if you have to pay for something else, or if you have to meet your day-to-day expenses, you are able to do that, right? If you had 15,000 cash here, you will have the cash balance of 5,000. You can meet your day-to-day expenses with that. Isn't it? Now let's take another example. This was about the current liability, right? Say you have a cash which is a current asset, say 10 lakh rupees you have. Now you decide to buy a car which is a fixed asset, right? You decide to buy a car which is a fixed asset which is worth 10 lakh rupees. Now if you spend the whole of this 10 lakh rupees on buying a car, you will have a balance 0. Then again the question is, how will you meet your day-to-day expenses? Clear? So this is very important. Working capital is what? That whatever the amount you have to pay, that is current liabilities, you must have the liquid assets. Cash is just one example of the current asset I am taking, right? So basically you are considering two things: cash, current asset and current liabilities. We also call working capital management as management of current assets. Management of current assets. We'll study one thing in ratio analysis. We'll study a chapter of ratio analysis where we'll talk about current ratio. Current ratio is what? Current ratio is current assets divided by current liabilities. And they say that the optimal current ratio is 2:1. That means if you have to pay someone 1 rupee, you must have 2 rupees in your pocket. So that 1 rupee you can pay to that person, and after paying him, you have 1 rupee in excess with which you can meet your day-to-day expenses. Right? So this thing also we'll study in ratio analysis. I'll go into depth of it when we'll study that chapter, ratio analysis. Right? One thing is clear, that if you have to pay someone 10,000, you must have in excess of that. That is the working capital. That is the amount that you will use to meet your day-to-day expenses. That is why it is said working capital is equal to excess of current assets over current liabilities. Clear? You must have excess current assets so that after paying off any current liabilities, you must be left with the money to meet your day-to-day expenses. Right, sir? So one thing is clear from here. What, sir? Working capital shows the liquidity of the firm. Working capital shows the liquidity of the firm. What is meant by liquidity, sir? When we talk about liquidity, see, what are our current assets? Our current assets are any assets which can be converted into cash. Within a period of less than 1 year. Within a period of less than equal to 1 year, right? That is, whenever we wish to, we can convert our current assets into cash. That shows the liquidity. Liquidity means how early or how quickly we can convert our current assets into cash. In case of an emergency, we have to use the cash, and how quickly our current assets can be converted into cash. That shows the liquidity of the firm, right? Here, what happens, sir? In the first example, here the cash balance is nil. Right? Now, in case of any emergency, if you get any emergency, you will have the cash balance? No, sir. Right? Here you have zero liquidity. You do not have any liquid assets with you. Liquid assets means all those assets which can be quickly converted into cash, and that cash can be used for the purposes whichever you want to use. Right? So if you do not have the cash, if you do not have the current assets, you have zero liquidity. And the excess of current assets over the current liabilities, that is the amount for day-to-day requirements, that shows the liquidity of the firm. That firm has enough cash balance, has enough current assets which can be converted into cash, right? And that can be used in case of any emergency within the business. And from the investor's point of view, it is always a good idea. They always look for a firm which has a good liquidity, because in case of any emergency, in case of any losses in the business, that liquidity will definitely help, right? So working capital shows the liquidity of the firm. More the working capital, more is the liquidity of the firm. More is the liquidity of the firm, and vice versa. Clear? More the working capital means you have sufficient current assets over current liabilities, right? Say you have to pay someone 10 rupees, right? This is your current liability. You have current assets of 30 rupees. So what is your working capital? So what is your working capital? That is 20 rupees. So you have sufficient liquidity, liquid assets in your pocket to meet your day-to-day expenses, right? This 20 rupees can be used in case of emergency or in case of any other requirement to meet your day-to-day expenses, right? So more the working capital, more is the liquidity of the firm, and vice versa. Now one question arises here, sir, that means in case the company should keep lots and lots of liquid assets, the company should keep lots of cash with it, because that will help in the higher liquidity, that will help the business in case of emergency. That means the business should keep lots and lots of working capital, isn't it? They should keep all the money in the working capital and should not be investing somewhere or something like that. They should keep all the money in working capital, whatever the cash is there, whatever the bank is there, whatever the current assets, everything, lots and lots of working capital is to be kept. No, even that is wrong, right? So we say that amount of working capital, we say amount of working capital, amount of working capital should be just sufficient, should be just sufficient, right? It should neither be in excess nor be in shortage. It should neither be in excess. See, these notes are going to help you a lot, right? It should neither be in excess nor be in shortage. That is why I am making you write all these things. Keep making these notes with me, right? Because these are going to help you whenever you are going to revise and everything. These notes are definitely going to help you. So we say the amount of working capital should be just sufficient. It is not necessary that we should be hoarding the working capital. We should be keeping lots and lots of cash to increase the liquidity. Sir, why is it like that? What will happen if we have excess of working capital? What will happen if we have excess of working capital? Let's see. Let's say I have excess of working capital. What is meant by excess of working capital? What is first meant by this? Say you have a current liability, you have to pay someone 10,000 rupees, right? And your say day-to-day expenses, let's for example day-to-day expenses for a particular month or something like that, we can say for a particular period, we can say are say 15,000 rupees, right? So what should be your working capital? Ideally, we will say the working capital should be whatever you want to pay to that person plus whatever the expenses are. You must have the current assets equal to 25,000, isn't it? This should be your current assets, right? You must be having the current assets of 25,000. Okay, I'll not write working capital. You people will get confused. I'll say you must have the current assets of 25,000, so that after paying off a current liability of 10,000 rupees, you have 15,000 for your day-to-day expenses. You must have current assets of 25,000, right? This is you should have. But in actual, what is there? You have current assets, or you can say the cash of 10 lakh rupees. You are having a cash of 10 lakh rupees. You have to pay someone 10,000. Your expenses are 15,000. That is total 25,000. But you are having a cash of 10 lakh rupees. So is it a good idea to keep it like that? Is it a good idea? No, sir. This is not a good idea. What is the problem in this? Say you are having a cash. What is the problem with that? The problem with that is you are having a cash of 10 lakh rupees, whereas your actual requirement is just 25,000. Your actual requirement is 25,000. That means 9,75,000 is the excess cash that you are having. is excess cash that you are having. Now this will lead to opportunity cost. How? This 9,75,000 you could have deposited in bank. You could have deposited in bank, right, and earned interest on this, and earn interest on this, isn't it? This 9,75,000 which was not required to be kept in the cash, but as you just listen to the half of concept of working capital, you thought that it is good to have higher liquidity, you kept a cash of 9,75,000, whereas you could have deposited this 9,75,000 in the bank, you could have done the fixed deposit, whatever you have invested somewhere, and earned interest on this which you have lost. Why? Because you kept it in the cash, right? So this is this interest loss, we call it as interest loss. This interest loss is what? This interest loss is your opportunity cost, right? This interest loss is your opportunity cost. That is, we say that working capital should neither be in excess nor be in shortage. If you keep it in excess, that means you have excessive investment in the current assets which is not required, which is leading to your increased opportunity cost, right? The amount which you have invested in the current asset in cash, you are keeping the amount in the cash, you could have invested that amount somewhere and earned interest on that which you are not earning by keeping it in current assets, right? So the working capital, that is why this chapter is important. That is why the first part of this is estimation of working capital, that how much of the working capital do we need, right? How much working capital should we keep in the business so that it is neither in excess nor in shortage. Now what will happen if we have the shortage of working capital? Excess we have discussed. What will happen if you have the shortage of working capital? Shortage of working capital. Shortage, what is meant by shortage? You have a current liability of 10,000 and you have a cash of 10,000. So your working capital will be zero. This will hamper your day-to-day activities, right? You will not be able to meet your day-to-day expenses and this will hamper your day-to-day activities of the business, right? So this is the purpose of this chapter, that we should have adequate amount of working capital in the business. It should neither be in excess nor be in shortage, right? And working capital, as I told you, is the excess of current assets minus the current liabilities, and it is also known as management of current assets, so that the excessive investment should not be there in the current assets and the short investment should not be there in the current assets, right? So if we summarize it, the working capital is the amount which is required for a short period of time, right, to meet our day-to-day expenses. And if you have, that means it is the excess of current assets over current liabilities, means if you have to pay someone 10 rupees, you must have 20 rupees in your pocket, so that 10 rupees is paid to the person to whom it was to be paid, and the remaining 10 rupees you can use it as a working capital to meet your day-to-day expenses, right? So this is the basic of working capital. In the next lecture now we will discuss about the types of working capital, right? That is important from the theoretical point of view. Types of working capital. Then we will study about the need for working capital. Why there is a need for working capital? Why do we study working capital? That is very, very important. From that need for working capital is basically the start of the practical part, right? Till now whatever we are discussing is theoretical part. We are understanding the basics. Here also we understood the basics of what is working capital, how this working capital is doing, right? How much of whether the excess of working capital is good or whether the shortage of working capital is good. And this is the base of this chapter, right? That is the main purpose, that it should not be in excess nor be in shortage. That is why this chapter has been framed, that you should know what is the right amount of working capital that should be invested in the business. right? Then we should be knowing about the types of working capital. That is important from the theoretical point of view, right? So next lecture we'll discuss about types of working capital. Types of working capital. We'll keep these lectures short. That is, I'm keeping it for around 30 minutes only, 35 minutes lecture. So it is easy for you people, and you will be getting the sufficient number of views. You will be getting 3 to 4 views easily for each and every chapter. That will be more than sufficient for you, right? So the next lecture will be types of working capital, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.